All right, let's talk about Costco's latest quarter. So you've got this situation where they absolutely knocked it out of the park with their Q1 numbers for fiscal 2026. I mean, the results look great, but then the stock just kind of went nowhere. It's what we call a classic beat and fade, and we're going to dig into exactly why that happened.
So let's start with the results themselves. Look, on the surface, this was a fantastic report. A classic beat, right? Costco did better than what Wall Street was expecting on all the key metrics. It really should have been a clear win for the stock.
All right, let's get into the nitty-gritty here. I mean, check out the quality of this beat. Earnings per share, $4.50. That's a whole 23 cents higher than what analysts were predicting. And yeah, there was a 16-cent tax benefit in there, but even if you strip that out, you're still looking at a solid beat. Revenue was pretty much spot on with expectations, and that 6.4% growth in comparable sales, that tells you people are still flocking to their stores.
And this is where it gets weird. This is the puzzle. So right after the earnings dropped, the stock did exactly what you'd expect. It popped. It was up over 1% in after-hours trading. But then, the next day, poof, all those gains just vanished. The stock ended up basically flat. It's a textbook beat and fade, and it's super frustrating for investors.
So, what gives? That's the big question here, right? How can a company report numbers this strong and get such a lukewarm, meh reaction from the market? What's lurking under the surface that just canceled out all that good news? Well, to figure that out, we first have to really appreciate just how much of a well-oiled machine this business truly is.
Okay, so before we get to the worries, let's dissect the growth engine. Because honestly, to understand why the market is hesitant, you have to see just how powerful the fundamentals are at Costco. First, let's talk about that 6.4% jump in comparable sales. That's a really impressive number. And what's great is that it wasn't just because of higher prices. It was a super healthy mix of more people coming in, traffic was up over 3%, and people spending a bit more each time they visited. That's the kind of balanced, resilient growth you love to see.
Now check this out. Their digital sales, up over 20%. This is huge. It shows that all the money and effort they've been pouring into their website and app, that whole omni-channel strategy, it's really starting to pay off big time.
And you might be asking, what's driving that digital growth? Well, here it is. Mobile app traffic shot up by almost 50%. That's insane. It means members aren't just using the app to shop, they're really engaging with it, which is exactly what Costco wants. It builds loyalty and, of course, drives more sales.
And this is where you see that famous Costco flywheel just spinning beautifully. Membership fees, which, let's be honest, is their secret sauce, were up a whopping 14%. And get this, their best customers, the executive members, are their fastest growing group, up over 9%. That means people are actually choosing to pay more for a better membership. And they did all of this while keeping their margins stable. I mean, the model is just humming along perfectly.
Okay, so if the business is firing on all cylinders, what's the deal? Why the flat stock price? Well, now we're going to pivot and look at the things that are clearly making investors a little nervous. The overhangs that are weighing on the stock, even with such a great quarter.
And here's concern number one. Now, at first glance, these numbers look amazing. And they are. But if you look really closely, you'll see that both renewal rates tick down just a tiny bit by 10 basis points. Now, that might sound like nothing, but for a business like Costco that's built on that sticky, recurring membership fee, it's like a tiny crack in a windshield. Wall Street notices everything, and even a hint of churn gets their attention.
So what's the deal with that little dip? Well, management was pretty upfront about it. They said it's basically a mix issue. They're signing up a lot of new members online, which is great, but these members, who are often younger, just don't renew at quite the same high rate as people who sign up in the store. The good news is they know about it and they've got a plan. They're going to use targeted emails and offers to try and get those online signups to stick around.
The other big cloud on the horizon is tariffs. But you know what? Costco isn't just sitting on their hands waiting for it to happen. Management laid out a really clear, four-part playbook for how they're going to handle it. They're shifting where they make things, buying more stuff made in the US, cutting down on the number of items that could be affected, and of course, leaning super hard on their own Kirkland brand to control the supply chain and costs.
And honestly, this quote from the earnings call just sums it all up, doesn't it? This isn't just some business strategy for them. It's who they are. It's in their DNA. Every single thing they do is about protecting their reputation as the absolute best place to get a deal. That's their North Star, and they will not compromise on it. All right, so we've got this picture of a company that's running like a dream, but there are these nagging concerns for investors. So let's put it all together and make a call on the stock.
So here's the dilemma, right? You've got a world-class company that is just executing flawlessly. But at the same time, the stock is already expensive, and you've got these little worries about renewal rates and tariffs starting to creep in. So, what's the call?
Our call on Costco is market perform. Plain and simple. It's a fantastic company, but the stock is already priced for perfection.
Now, giving it a market perform rating isn't a knock on the business at all. What we're saying is that all the good news, that incredible execution, that loyal customer base, it's already baked into the stock price. The valuation is high, which means there's just not a lot of room for things to go wrong. So what are we watching? For the stock to go higher, we need to see those renewal rates stabilize and for them to keep margins strong. On the flip side, the big risks are if those renewals keep slipping or if margins start to get squeezed. That could easily cause the stock's high valuation to come down a bit.
And that's our take on Costco's quarter. It's a fascinating story of a company doing everything right, but a stock that might just be ahead of itself. It's definitely one to keep a close eye on. And as always, please remember, this is not financial advice.